Hey team, welcome back to our bi-weekly session. In today's live video, we went over avoiding false breaks in stock offerings. Today, I'll keep it brief and share with you some tips and tricks on how you can avoid offerings and these false breaks when day trading. If you find any value in today's video, please give it a thumbs up and share it with your fellow traders. Welcome back, team. Today's session we will be going over avoiding false breaks and stock offerings and keeping it simple, right, guys? Because that's what we do around here. We keep it simple. We want to learn how to avoid false breaks and stock offerings, and we're going to give you a few tips on how you can do that. So, guys, good day, everyone. Welcome to today's class on avoiding false breaks and offerings in day trading. As many of you know, navigating the stock market can be challenging, and one of the key skills to master is the ability to distinguish between genuine and false signals. False breaks and misleading offerings can often lead to significant losses if not properly identified and managed. And that's right, guys. We all know that. So let's grow together. In today's session, we will dive deep into understanding what false breaks and offerings are, how to identify them, and then most importantly, how to avoid falling into their traps. By the end of this class, you should feel more confident in recognizing these pitfalls and making more informed trading decisions. This knowledge is crucial for maintaining and enhancing your probability as day traders. Let's get started and equip ourselves with the tools and strategies needed to stay ahead in this market. Let's do it, guys. All right, key points and tips for understanding false breaks. The definition of a false break occurs when the price moves beyond a support or resistance level, giving the impression of a breakout only to reverse direction shortly after, right? So it just pulls right back. So it looks like it's breaking out of a level and pulls back. The causes for this, there's many causes for this. Market manipulation, low volume, or news events that can lead to false breaks, right? Low volume is a really important one because if you have low volume, then typically what's happening is it's a very weak breakout, right? So maybe it closes over your key level, but maybe it's doing it with very low volume, and that could be considered a weaker breakout. So we want to make adjustments based on what we're seeing. So how to identify these false breaks? Well, there's volume analysis. True breakouts are usually accompanied by a significant increase in volume. A breakout with low volume is a potential of a false break, right? And we know that. If it has higher volume, that means there's a lot of strength. There's a lot of traders involved in this. That means that it's bullish, right? A lot more bullish than something that's going to have maybe 2,000 shares. So if you have something that closes over a level with 2,000 shares versus something that closes over with 100,000 shares, there's a big difference there. There's a lot of attention on the 100,000 share stock. Candlestick patterns. Look for reversal patterns such as the doji, pin bars, and engulfing candles near the breakout point, right? Dojis can sometimes be indecision candles, right? They look like that cross. They have a long wick above, a long wick below, and a small body. And we'll go over this at the end of this video. I'll pull up the chart as well. But a doji is like an indecision candle. It's not sure which way stock wants to go. These are different types of candlesticks that can really identify whether it's a false break or not. So if you see a bunch of wicks or the stock gaps up but keeps hitting a level and falling back down, well, then that could give you potential that it's a false breakout because there's a lot of rejection at that level. Confirmation. Wait for confirmation by checking if the price holds above or below the breakout level. So we're looking for a candle to close over that key level. So a false breakout of our key level looks like this. We've got a line, right? We've got these wicks, and it does not close over. So if we're looking for a close over and we're trading confirmation, which is my go-to strategy, then we're looking for a candle to close over this level. And we can see here we had a couple wicks, and that is considered a false breakout of our key level, and it gaps back down soon after. So some techniques to avoid false breaks. One is confirmation rules. We've got rules to our strategy. One critical rule for our strategy is if the 1 minute candle closes over the key level for our entry, that is our signal to go into the position. And if it closes back below that same level, that is our signal to exit the position. So very cut and dry, confirmation is looking for a close over as bullish, close below as bearish. And that will save us from false breaks because sometimes if the candle is giving that long wick it has not closed yet, right? It hasn't closed over the key level yet. So that is a false break. So we're waiting for the candle to close. That's the rules to our strategy. Other technical indicators can help, right? The RSI, MACD, stochastic. These are just common technical indicators that can help you avoid false breaks as well. If you see that maybe the RSI is too extended and it's closing over your key level, well, maybe that's something that's identifying those false break type of conditions. And maybe we want to either adjust our size and tighten up our stop loss or avoid that trade altogether because, again, it looks like it may be presenting as a false break. Now, it doesn't mean that the RSI can't be extended and it still continues to gap up. Doesn't mean it can't happen. But what it means is that this is something that is a red flag, right? And as day traders, we are mitigating risk. We're looking for these red flags to help mitigate risk. And if we see that this stock or the price at this time and the close over this level is higher risk due to these other factors, well, maybe we want to take a smaller size to adjust for that risk. So we're risk assessors. We're assessing for the risk. If the stock is hurting for cash, well, typically, if they're hurting for cash, they're going to be coming out with an offering, and we're trying to avoid those offerings at all cost. So it can be hurting for cash, and there's tools out there like dilutiontracker.com that can give you a heads up if the stock is hurting for cash and if it's a higher probability for a stock offering to come out. And if it's a higher probability for that offering to come out, then we want to be very careful because then short sellers are licking their chops and saying, hey, this thing is at a high risk for that offering. It may just drop, right? And we've seen single candles pull back a negative 40% at a time, right? We've seen a 1 minute candle pull back on an offering 40% or greater. We've seen that plenty of times. So you want to be very, very careful with trading around stocks that are hurting for cash and are looking for a way to get that cash up. And an offering will dilute the shareholders, but it will increase the cash for them so that way they can stay in business, right? And a lot of these stocks, guys, they're just unfortunately burning through cash like crazy, and you can't really blame them because a lot of them they don't have anything to sell, right? They're not selling a product. Some may be biotech type of companies. Some may be tech companies that are just starting up. Whatever the reason is, if they're hurting for cash, then they're at risk for an offering to come out. And tools like Dilution Tracker can give you a heads up on that. The candle close. Here's some tips, guys. The candle close. By waiting for the candle to close before we're entering, we are waiting for confirmation. And this is my go-to strategy. This will help identify false breaks and aid in avoiding, right? So if we're waiting for the candle to close over our key level, and it didn't close over, very similar to this example right here, if it didn't close over, well, we didn't take the trade. We're looking for this close over for our entry. So we avoided a false break, and I can't tell you how many false breaks we avoid each day. Stock offering risk. If the stock needs cash to survive, they may announce a stock offering. And it makes sense, right? Again, if they're burning through cash and they don't have any cash on hand and they need it to survive, otherwise they'll go out of business, well, it just makes sense that they're going to have an offering, right? For myself, oftentimes I'm trading confirmation. And for confirmation, it typically will close below my support level and fade off before that offering comes out. I would say 9 times out of 10. I haven't seen it happen where it gives an offering while it's above my key level. But that being said, doesn't mean it can't happen. So I want to plan for that and be careful regardless. If they're hurting for cash, I want to be careful. Let's dive into the charts. Let's go ahead and pull up the charts here, and I'll pull up some examples. All right, so now we have a good example here on Cavill. We've got some lines drawn for our levels, and what we're looking for is false breaks. So if I zoom out and we look to the left-hand side here, and I zoom in on Cavill's move, what we can see here is the conditions were unfavorable, right? These are a lot of green bars, right? We call this a bullish vertical trend because there's so many green bars in a row, 5 or more. And this is a red flag to our strategy. So a close over our key level, yes, is still bullish, but it's higher risk. It's going to be a higher risk setup or entry because what it's having here is a bullish vertical trend. So this is a red flag. So again, being a stock risk assessor, right? That's pretty much what we are. We're assessing the risk here and saying, okay, if I take this trade close over, I want to be aware of the conditions. The conditions are we have a bullish vertical trend, number 1. That's a red flag. Number 2, we closed over our key level. This 563 is our key level. We closed over, but then we hit our level above. So we filled that gap. And that's a red flag to our strategy because if we fill that gap, that means this is what we're looking for. We're looking for it to close over, hold this level, and hit target here and take some profit. Well, it already hit the target. So the probability of it hitting it again is less likely. Doesn't mean it can't happen, but this is a higher risk type of setup because of this. But say you got in, okay, we got in, closed above. Oh, now we closed above 2 levels, right? Same idea. Because we closed above this level, we now need to hold this new level. That level is 659. If we can hold 659, we look at the next level as our possible target, which is going to be 757. But below that, we've got $0.50. Don't forget the half and whole, half and whole. So 750 is right about here. So if I put a line here, that's 750. That would be where our target and our profit should be, right? Excuse me. So closed above, held, gapped up, hit our resistance level. Well, here we have a false break. False break of this key level. We did not close over. We're taking profit. Okay, great. Now we're looking for a close over to either get back in or extend our winning trade. And all of a sudden, it did not close over. This is a false break. And this is a nasty pullback candle right here. But as we close below this level, this is our last level closed over, which was 659. If we close below 659, well, we consider this to be bearish for confirmation. So this is what we're talking about. This is how you can avoid those false breaks. This closed over. It was high risk. Okay, we bump. Took profit. We're looking for a close over. Did not close over. We avoided a false break, pulled back, closed below our level. This is now bearish. If I'm trading below our recently closed above level, so our closed above level was 659 and 757 is the next key level. If I'm trading below 757 and 659, then I'm at risk for an offering to come out, because what it's doing is it gapped up, it's fading off, and that's typically where the offering will come out. Okay, so let's look here. Okay, Cavill just continued to fade. False break, fade. Let's see here. Here's some more false breaks. Okay, we got over. False break fell, failed the level, got back over, hit it. Okay, false breaks. If you're trading below here, again, this is no longer confirmation. This is considered a bounce watch. Confirmation needs to close over the recent levels tested up here. So that's going to be 757. So until we see a close over this line, we're not considering this to be confirmation, in which case we're trading a bounce watch, which we're at higher risk for an offering to come out, right? And that's why I'm not in love with the bounce watch plays. But that being said, look at this. Look at this beautiful move on this bounce watch. So if I measure this out, of course, this made about an 80% move or more, right? 80% from this bounce. Beautiful move on Cavill from a bounce watch play. But again, this is higher risk. So it doesn't mean I can't trade it down here. Just means it's a higher risk of that offering to come out, higher risk of major red candles to appear, and that means I need to make adjustments. So if I'm trading large size, say I'm trading 10,000 shares, well, down here maybe I'm trading 1,000 shares, maybe 500 shares, maybe 100 shares, right? Just a lotto or something. Well, it gapped up. All of a sudden, we're looking for it to close over the 757. Let's zoom in. So here's our level. We want it to close over this line right here, right? Get this out of the way, this line right here. Okay, we closed over here, came back down. This is at a topping tail, so this is concerning. Topping tail, and topping tail means that it has this long wick above. That means that there's rejection of higher prices. Rejection, false breaks. All of a sudden we closed over. Yes, it had a topping tail, but the body of the candle closed well above our 757 level. This is a bullish candle. And this is our entry, right? And our exit point would be up here at $8. There's $8 and 808 because that's our key level. So as we gap up, boom, next candle, 1 minute scalp. We have our profit. We took profit. Okay, we have a false break of our key level. Now we want to see it close over 808 before we consider this bullish again. And anything below 808, trading below this is considered a bounce watch and at high risk for an offering to come out. And again, we have seen an offering come out of a 40% negative candle, which I mean, this red candle could be a 40% pullback negative candle, right? Nasty. And that's something that we look to avoid. And that's because we're trading confirmation. We're trading above these levels. So as it gaps back down, okay, fail. We get back down. Let's see what happened here. And look at this. All the way back down here. So Cavill had a false break of our key level. So if you were in the trade at this key level of 757, well, you should take profit at $8 and 808. And if you're looking to get in the trade, maybe you didn't get in, you're looking for a close over our next level. Well, you're looking for that close over 808. It didn't happen. This is a false break. So by avoiding this false break, we're avoiding a major loss. Because if you were to get into this position, right? Let me zoom out here and let me do this. If you were to get in up here at this position because it looked like it was popping and it was going to break out over that level, right? This is a false break. This is something we're looking to avoid. You're down 44% on your position, right? Nobody wants to be down 44% on your position. And say, even worst case scenario, say instead they were hurting for cash, closed below our level and started to fade off here. This would be our exit signal no matter what. This candle closing below our level, this means get out, right? Get out of the way, right? Get in, get green, and get out of the way. Or get out of the way, right? I should say. So get out of the way here. As it gapped and closed back below our key level, we no longer look at this as bullish momentum. We no longer look at this as confirmation. And this is now at higher risk for an offering to come out. So say you didn't close out on this candle right here, right? And you said, you know what, I'll wait. This false break was okay. I'll wait for it to curl back up. I've got this, I've got this indicator. I've got whatever. I feel like it's going to go back up. That's my opinion, right? All of a sudden, an offering comes out because they're hurting for cash, and boom, it goes down 40%. So not only did you not take the loss here, but then it goes down 40%. You're now a new bag holder on KAVL. And a lot of us are trading around bag holders. We're using those bag holders levels as ways to take advantage of the market, right? So by avoiding these false breaks, guys, you can see that we're avoiding major losses, right? We're looking for false breaks. We're looking for clean candles to close over. And then there's other ways. As we mentioned, you can use technical indicators, something like the RSI, right? I've got the RSI down here. Turn this on. You see this. If you go to indicators, type in the relative strength index. There it is, relative strength index. Add that to your chart. You'll see what I see down here. And just using the common relative strength index, what you can see is that it's above. This oscillator is above. To keep it simple, I'll turn off the moving average here. Hit OK. Just this one line. This oscillator is what we call it, and we're looking for it to stay below up here. If you're above, let me double click on this. If you're above this line here, it's considered a general rule of thumb to be overbought and extended. If you're below this line down here, it's a general rule of thumb that it's oversold and extended to the downside. So this is extended to the high side, extended to the low side. So that means that typically when you have it extended one way, it's like an elastic band. It's going to pull back the other way, right? It doesn't always happen, but this is a condition that we look for as day traders that tells us that it is extended, right? And we can see that it started to enter that zone. It started to get above this line and level right here as we started to gap up. So all of these candles right here were extended, very extended price action. So that means that we can still trade it, but by identifying this indicator, just a really simple indicator here, we're now seeing and saying, okay, well, this could be a false breakout. This is at risk for that false breakout. And so in which case, I want to make adjustments based on the conditions that we're seeing. And this is just using the RSI. You could change the settings in the RSI. You could do maybe the 7-day on the RSI for more rapid signals. You can see, again, it's still oversold, or excuse me, overbought. So it's extended. And that's just a really simple way of doing so. And you can do that with a stochastic indicator. You can do that with the MACD. You can do that with the Bollinger Bands. It doesn't really matter, guys. You can do that with any indicator that's going to identify extended type of price action. And it doesn't mean that it won't continue. We've seen it plenty of times. The RSI can go all the way up to 100, basically. And it can just continue, right? But what it means is that we're risk assessors. We want to mitigate risk as best as possible. And that's the whole point of this session, is that we are trying to mitigate the risk and avoid those false breaks. So if I shrink this back down, you'll see that's what we're doing here. That's what this class is all about, right? Avoiding false breaks and avoiding these stock offerings. And so by using different tools, guys, Dilution Tracker is a great tool. I'm not affiliated with them in any way, but they are a great tool. I think they're like $10 a month, something like that. And they'll give you a heads up if a stock is hurting for cash. But again, me trading the confirmation strategy, oftentimes, it's got to close over the key level before I get in. So if it doesn't close over that key level, and we can see that it's struggling here, then that means I am avoiding this trade because I want it to close over the key level. And if I'm trading below this key level, if this is my line in the sand, above is bullish, below is bearish. If I'm trading in a zone that I consider to be bearish, well, then I'm at risk for an offering to come out. And I always look at that. So without even knowing the fundamentals, I always look at it as if it's below my key level, if it's below my support or my resistance, I do look at this as it's very, very high risk for an offering to come out because these are low float stocks, and you can't really blame them, guys. You can't blame them one bit. They are. It's expected that they need that cash, right? So it's completely understandable on their part, but at the same time, we're not looking to get caught in those either, right? So we're trying to be better informed here, guys, by avoiding these false breaks altogether. And there's obviously some tips on how you can do that. By looking at the chart we were just looking at, it did have high volume. But, if you see those low volume movers and it closes over your key level, guys, that's a low quality confirmation or a lack of confirmation altogether, right? It could just be, just a low quality setup in general because it has low volume. It's not showing a lot of strength. Now, we've seen stocks with low volume. We've seen micro float stocks, right? If it has a micro float under 1 million shares, you know, it could get crazy with low volume regardless of what we think. So it can close over the level and then just start spiking up and whatever. So it doesn't mean that we have to avoid those type of trades. It just means that if we're trading those type of trades, we just want to assess the risk and maybe lessen the size, right? Take a smaller size altogether. The candlesticks here, let's go over that real quick. Candlesticks can help out. Doji indecision candle is going to be something like, let's see, I'll turn this off. And see this red bar right here. This red bar that we're looking at right here is an indecision candle. This could be considered a doji as well. A doji is basically a candle. Same with this one here. These are candles that are really, the market is not really sure which way it's going to go. These are not very strong decision type of candles. If you see a candle like this closing over our key level, maybe it's going to give you, some red flags. If you see a green bullish candle similar to this one here, where it's got the wick at the bottom, where it's rejecting lower prices, but then closes over our key level, and it has volume, because of course lack of volume is a major red flag and something that we are concerned with. If it has the volume, which this one does, well, then that could possibly look for an entry, but it has to close over our key levels, which is going to be up here and above at the 808 now. So that's pretty much it, guys. A quick tutorial here on avoiding false breaks and offerings. Just a quick tip to go over. I'll go over what I see from some information here in Dilution Tracker. Dilution Tracker tracks events, guys, so it can give you alerts on whether or not a stock is at risk for that offering to come out. So are they hurting for cash, in other words, right? Dilution Tracker will do that for you. They'll give you alerts and let you know, yes, this stock is hurting for cash. And, that could be used in multiple ways. It doesn't have to just be a way for us to avoid these trades, but maybe you're a short seller. Maybe you like to trade stocks in the short direction. And if so, then maybe seeing something that has a high risk of an offering coming out and pairing that with a fail of our key level and a close below our key level, maybe that's your go-to strategy. Maybe that's something that you can implement into finding your short positions, right? So Dilution Tracker is great because it's going to give you those heads up type of alerts where you can then make better informed decisions. And that's what we're trying to do here, guys, right? That's really what we're trying to do. So Dilution Tracker is best suited for short sellers who are looking to trade around new offerings and dilution events that can be used. Dilution Tracker to identify companies likely to dilute shares and see their stock price fall, right? But with that being said, it doesn't mean that you can't use it as a long trader as well. One of our day traders like myself, we can use it in conjunction because, again, if we just have a quick tip that this is at risk for the offering to come out, we'll use that in conjunction with other conditions similar to our close above, close below, to identify conditions. Long-term investors can look at this as a significant tool as well, Dilution Tracker, because if you're a long-term investor, maybe you want to see something. If they're hurting for cash, well, maybe you don't want to get into it, right? I don't personally swing trade low float stocks, but maybe you're trading stocks like Tesla, Apple, SPY, whatever it may be, Nvidia, AMD, and maybe you want to see, are they liable for an offering as well, or is this something that they're ahead of and they're fine, right? They're not burning through their cash like crazy. So that's something that's really helpful, guys. Just a tool that you can use. But that's pretty much it, guys. If you have any questions, feel free to reach out. I will be in the chats throughout the week, and I'll be happy to go over this with you. But again, there's different ways you can avoid these false breaks, and that's what we're trying to go over. There's different ways to avoid offerings, and that's what we're going over as well. So keep an eye on this, guys. If you see something like this, be careful, because this is considered a false break and something that we want to avoid. By trading the confirmation strategy, we're looking for a candle to close over that key level. I use 1-minute charts, and I'm looking for a candle to close over with volume. And of course, if we see that, then it is go time for me. So guys, I appreciate your time. I hope you learned something in this video. If you did, give it a thumbs up, and I'll see you in our next live session. We have a bi-weekly session every other week. So next week we'll have off, and the following week we will have a live session going over some day trading strategy as well. Guys, appreciate your time. Hope you have a great weekend, and I'll see you in the next one. Thank you for watching. If you found this tutorial helpful, please like, subscribe, and visit BullishBobLive.com for more powerful trading strategies. Remember, be patient, stay disciplined, and I'll see you in the next video.